Okay, welcome back to our second part of monetary policy. Uh, Please do keep in mind that the objectives of monetary policy are exactly the same as the objectives of overall macroeconomic policy. Because, of course, macroeconomic policy is divided into two types: monetary policy and fiscal policy. So the objectives of this will be the same: controlling unemployment, controlling economic growth, controlling balance of payment, controlling inflation. The difference will come not in the objective but in the tools. The tools of monetary policy are, and these are in order of decreasing significance and significance of use and significance of impact. First and foremost, OMO, open market operations. We will see what they are, but because we have seen the bond market, now we will be able to understand this faster. And then there is reserve ratio, discount rate, special deposits, and qualitative measures. So let's quickly look at OMO, open market operations. The government regularly issues bonds and securities. The bonds, we know, these are instruments that the government sells, certificates that the government sells, and once it sells, it is able to borrow money. In the process, the government is able to remove money from the money supply. It is able to reduce the money supply. Okay, so if the objective of the government is to reduce the money supply, it is going to sell bonds in open market operations. And if the objective is to increase the money supply, then the government is going to buy back the bonds, and that way it's going to put more money in the hands of the people. So please do keep in mind that this is a regularly used method. Okay, so this diagram shows it beautifully. It says that when the government wants more money in the hands of the public, what does it do? It buys back the bonds in open market operations, and vice versa. This is quite clear, and I've already explained this to you. Okay. Then the second method that the government uses is the change in. Now, please do keep in mind that this is not the government as such which is doing all this. The central bank is doing this on behalf of the federal government. So please do keep in mind that this policy, the monetary policy of the government, is implemented through the central bank. The central bank can change the reserve ratio. Okay, and we know from our understanding of the credit creation process that if the reserve ratio is increased, then the money supply falls very quickly. Okay, the money will be removed from the banking system very quickly, and there will be a contraction, a huge contraction, because if the money supply, if the reserve ratio, for example, the reserve ratio is the amount of money which the bank has, but it cannot lend, it will have to keep it back. So if the reserve ratio is increased, let's say from 10% to 15%, then there's going to be a massive reduction in the money supply, very very fast, very very quickly. And that is why this measure is, as we saw in the video on reserve ratio and credit creation, this method is not very regularly used, but it's a very potent method. That is something that you need to keep in mind. It's a very strong method. So the government, simply by increasing the reserve ratio, also called the liquidity ratio, it can decrease the process of credit creation, reduce the process of credit creation, and hence reduce the money supply. And if the government wants the money supply to increase, it can always reduce the liquidity ratio. That's the second thing. Third thing, the government can ask the banks to deposit money into special accounts in the central bank. Once again, once this money is deposited with the central bank, this money goes out of the system. It cannot be seen as a source of regular money supply in the economy. All right. Fourthly, what the government can do is, or what the central bank can do is, it can change the minimum lending rate. Now, this is something that needs to be understood a little bit. What is the lending rate? MLR, also called the discount rate, please keep in mind that the commercial banks, when they need cash, they will borrow from one another. Okay, they will borrow from one another. This is called the interbank market. The interbank market, and the rate at which they borrow, the interest rate at which they borrow, is called the interbank borrowing rate. So that happens. So if a bank needs money, it will go to, let's say, bank A needs money. Now bank A goes to bank B. They say we cannot lend money. We also don't have the money. It goes to bank C. They also don't have the money. So now bank A is left with only one option. It can go to the central bank and it can request for a loan. It can ask them to lend the money. But they can only do that if they cannot get money from other banks in the banking system. So the central bank will lend money only in the end. That is why the central bank is also called the lender of the last resort. Okay. And when the central bank lends money, it will lend it, of course, at an interest rate. But this interest rate is the lowest interest rate at which you can borrow. Okay, the other banks will lend money at a at a premium, or at a certain rate higher than this rate at which the central bank is offering the money. So please do keep that in mind, that the rate offered by the central bank is the minimum rate, and then the other banks can charge rates slightly over and above that. Because it's the minimum rate, it's, we call it MLR, the minimum lending rate, and also the discount rate. Okay, so now if the government wants, or if the central bank wants the money supply to decrease, what will it do? It is going to increase its minimum lending rate. Let's say it increases the minimum lending rate from 2%, just for the sake of argument. 2%, the minimum lending rate was 2%, and it now goes up to 5%. So what is going to happen? The other banks, they will increase their interest rates also. Okay, they will increase their interest rates also, and this is going to, when interest rates go up, what's going to happen? It is going to take money out of the system. There's going to be a reduction in the money supply. All right, so by increasing the this discount rate, the government can reduce the money supply, it can reduce economic activity, it can reduce inflation. And by reducing this, because now when the government reduces its discount rate, when the central bank reduces the discount rate, what's going to happen? Previously, let's say the MLR was 3%, so the banks were lending at 5%. Now government reduces it to 1%. So now the banks will also charge a lower interest rate. So by increasing the MLR, the money supply is reduced. By decreasing the MLR, the money supply increases, because the interest rates overall are going to fall. Another thing is qualitative measures. All right. Here the government can simply say, or the central bank can simply ask the commercial banks not to lend to individual borrowers, not to lend to people who want to borrow money for too much consumption. Because if you continue to lend them and they continue to consume, what happens? There will be more money in the system, and there will be more inflation in the system. So these are things that can be done. This diagram shows the relative importance, of course, and the importance in terms of use. Open market operations are very regularly used. Okay, then reserve ratio, then discount rate, then special deposits, and qualitative measures. Okay, so we divide, as you have seen, we have divided the monetary policy into two types. There is contractionary and there is expansionary. So when the government wants to expand the economy, what's it going to do? It's going to buy back the bonds in open market operations. The government now wants to expand. It wants the money supply to increase. So it's going to buy back the bonds, and it's going to put more money in the hands of the people. If it wants to expand, what is the government going to do in terms of the reserve ratio? They are going to reduce the reserve ratio. When the reserve ratio is reduced, more money in the system, more activity. When government wants to expand the economy, what is it going to do to the discount rate? It's going to reduce the discount rate, because now interest rates will fall, more money in the system. Special deposits, what is it going to do? It's going to ask the banks to withdraw money from the special deposits. What will it do to the qualitative measures? The qualitative measures, the government is going to uh, ask the banks, permit the banks to lend money to people for consumption purposes. That is going to increase the money supply in the system, create more activity, create more employment, create more income, and incidentally create more inflation as well. Okay, so please do keep in mind. And if it's contractionary, if the objective is contractionary, to contract the economy, then the reverse is going to happen. All right, so please do revise this, and if there are any questions, then you can leave the questions in the comment section. In the next video, we are going to look at the relationship between the various markets. Most importantly, which is very important for you to understand, is the relationship between the money market, the relationship between the money market, the bond market, the investment market, and the regular consumption market. And that is explained best by the the transmission theory and the monetary transaction mechanism, which we are going to look at in the next section. Okay, thank you very much indeed.